Have you ever walked through Las Vegas? It's a sensory overload, isn't it? A dazzling, chaotic symphony of flashing lights, ringing slot machines, the faint, persistent smell of desperation mixed with industrial-grade air freshener. You see the names: Bellagio, MGM Grand, the Cosmopolitan. You think of them as distinct, competing kingdoms. But what if I told you many of these iconic properties are controlled by the same entity? Not a flashy mogul, but a faceless corporate behemoth in a New York skyscraper. It's like discovering all cereal brands are made by one giant hamster in a suit. The old saying, "the house always wins," needs a modern update. The question isn't just about blackjack odds, it's about who owns the table, the chair you're sitting in, the ground beneath the casino, even the air you're breathing. The answer, in many cases, is a private equity firm called Blackstone. Yes, Blackstone. It sounds less like a casino owner and more like a company that would build dystopian police robots. Their dominance affects the workers who keep the lights on the local communities that depend on these resorts and every person who visits. So why should you care? Because when one company owns this much, the rules change. It becomes about maximizing returns for investors. This is a fundamental shift in the DNA of places like Las Vegas, with real consequences for workers, communities, and your vacation. It's a high-stakes game where the chips are hotels and the jackpot is billions. The story isn't glamorous. It's financial engineering and consolidation of power, a quiet takeover beneath neon lights. Tonight we'll pull back the velvet rope, walk past the bouncers and see the company that's become the new house. A house set up to win more than any casino ever could. What we find is more boring and infinitely more terrifying than you can imagine. So, who or what is Blackstone? You might not have heard of them. That's by design. They prefer it that way. Blackstone is not a bank you can walk into. They don't sell phones or streaming services. They're a private equity firm. In other words, a gigantic, world-eating Pac-Man for assets. They manage an obscene amount of money, nearly $1 trillion. A number so large it's basically cartoon scale. They take this mountain of cash from super rich people, pension funds, sovereign wealth funds, then they go shopping. Not groceries, entire companies, massive real estate portfolios, critical infrastructure. Think of Blackstone as the world's most powerful, least fun landlord. One of the largest owners of commercial real estate on the planet. Single-family homes, logistics warehouses that Amazon uses, office buildings, student housing, SeaWorld. Yes, SeaWorld. Cue the depressed orca. Their business model: buy something, make it more profitable, often by cutting costs, raising rents, or loading it with debt, then sell it years later for a massive profit. Financial surgeons, performing a radical wallet-ectomy. Their influence is everywhere, hiding in plain sight. That warehouse your online order shipped from, they might own it. And that brings us back to Las Vegas. What's more perfect than a massive, glittering casino resort? For Blackstone, a casino is the ultimate real estate play. Okay, let's take a quick time out for a term you just heard: private equity. It sounds complex and boring, and honestly it is. But the concept is surprisingly simple, so let's break it down. Imagine you have a lemonade stand. It's doing okay, but you want to expand. A private equity firm, let's call it Lemonstone, comes along. Lemonstone doesn't just give you a loan. Instead, they use a little of their own money and a lot of borrowed money, debt, to buy your entire lemonade stand. Suddenly you don't own it anymore, they do. It's now a private company owned by them, not by public shareholders on the stock market. That's the private part. Now, Lemonstone doesn't love your lemonade, they love money. So their first order of business is to make your stand more profitable, fast. They might fire your cousin who was helping you switch to cheaper, powdered lemon mix instead of fresh lemons, and jack up the price from 50 cents to $5 a cup. They might even make you sell the stand itself, the physical wooden structure, to another company they own, and then force your lemonade business to pay rent to use it. This is a classic move. After a few years of these efficiency improvements, the lemonade stand is making a ton of profit on paper, even if the product is terrible and the customers are unhappy. Now comes the equity part. That, in a nutshell, is the private equity playbook. So how does this private equity playbook apply to a giant glittering casino? It's actually a perfect fit. Blackstone's strategy in Las Vegas has been less about running the slot machines and more about becoming the landlord to the people who run the slot machines. They pioneered a model that is both fiendishly clever and deeply concerning. It's called a sale-leaseback transaction, like the lemonade stand example, but on a scale that is hard to comprehend. Basically, Blackstone doesn't want the headache of actually operating a casino. That's messy. You have to deal with gaming licenses, employees, customers complaining that the cocktail waitress is ignoring them. Instead, they approach a casino operator like MGM Resorts and make them an offer they can't refuse. We will buy the physical buildings and the land your casino sits on for billions of dollars in cash. Then, we will sign a long-term contract to lease it all back to you. You get a huge pile of money right now and you can keep running the casino as you always have. You just have to pay us rent, a lot of rent, every month, for the next 30 years. For the casino operator, this is tempting. They get a massive cash infusion to pay down debt, invest in other things, and they offload the real estate from their books. This is exactly what happened with iconic properties. In 2019, Blackstone bought the real estate of the Bellagio for an eye-watering $4.25 billion. MGM, the former owner, immediately signed a lease to continue operating it. They agreed to pay Blackstone an initial annual rent of $245 million. At this point, you might be asking, why casinos? Why not just buy more office buildings or shopping malls? Well, the answer lies in the unique nature of casino resorts. Unlike a generic office building that can lose a tenant or a shopping mall that can fall victim to online retail, a massive Las Vegas casino is what investors call an irreplaceable asset. You simply cannot build another Bellagio with its famous fountains across the street. These properties are iconic, they have a built-in global brand, and they sit on the Las Vegas Strip. For a real estate investor, this is, honestly, the jackpot. Furthermore, casino resorts are cash-generating monsters. They're not just hotels, they're a vertically integrated ecosystem of profit. Gaming floor, thousands of hotel rooms, dozens of restaurants, high-end retail stores, massive convention centers, theaters hosting world-famous acts. Each is a separate revenue stream flowing into the same building. This diversification makes them incredibly resilient. If gambling revenue is down 1/4, a massive tech conference at the convention center can make up for it. If restaurant sales are slow, a blockbuster concert can fill the rooms. It's a landlord's dream. Casino operators like MGM Caesars are locked into these locations. It's the ultimate landlord-tenant relationship, with all the leverage on one side. They're not in the casino business, they're in the rent collection business. To see Blackstone's strategy in action, look at two of the most famous properties on the Strip, the Bellagio, the Cosmopolitan. These two examples show their two-pronged approach. First, the Bellagio. This was a quintessential sale-leaseback. Blackstone's real estate arm, Brait, bought the property. Operations stayed with MGM. Blackstone became the invisible landlord, collecting giant rent checks. Hands-off model. Now, the Cosmopolitan. Blackstone bought it in 2014 for $1.73 billion. The casino had never turned a profit. This time Blackstone bought the whole operation. They applied the private equity playbook. They revamped the casino floor, redesigned hotel rooms, tweaked the business strategy, targeted a younger, more affluent crowd, focus on high-end food, focus on nightlife, less about gambling. And it worked. Huge success. But PE doesn't hold forever. In 2021, after 7 years, Blackstone flipped it. They sold the operations to MGM, then sold the real estate to investors including Brait. A circular move. Recap, bought a failing casino, fixed it up, sold the business to its biggest tenant, sold the building to itself. Total sale price, $5.65 billion. Bought for $1.73 billion, nearly $4 billion profit. Tale of two casinos, landlord or boss, same end, a massive payday. This all sounds very impressive from a business perspective. Billions of dollars. Clever deals, massive profits. It's the kind of thing they make documentaries about for people who wear vests to work. But there's another side to this story, and it doesn't involve champagne and soaring stock prices. It involves the actual human beings who work in these casinos and live in these communities. When your employer's primary duty is to a private equity firm in New York, your job security, your wages, and your working conditions can become line items on a spreadsheet, ready to be optimized or cut at a moment's notice. The pressure to service the massive rent payments in a sale-leaseback deal is immense. A casino operator who now has to pay hundreds of millions in rent to Blackstone has to find that money somewhere. And that often means operational efficiencies, which is corporate speak for cutting staff, reducing hours, freezing wages, or making employees work harder for the same pay. Suddenly the focus shifts from long-term guest experience to short-term cost-cutting to make sure the landlord gets paid. Workers, from housekeepers, cocktail waitresses, dealers, chefs, are the ones who feel this squeeze first and hardest. They are the shock absorbers for these mega deals. For visitors, the changes can be more subtle, but they are there. Longer lines at check-in because the front desk is understaffed, Complimentary drinks on the casino floor become harder to come by, a general feeling that the resort has lost some of its soul, replaced by a relentless focus on extracting every possible dollar from your pocket. This is the inevitable result when a property is managed not for hospitality, but for its ability to generate a predictable return for a real estate trust. The magic of the experience can be one of the first things to be optimized away. This creates a fundamental tension between the people who make the city run and the people who own the buildings they run it in. So why does all of this feel so secretive or surprising? The main reason is that Blackstone has been incredibly clever about it. They are not putting their name in giant letters on the front of the Bellagio. There is no Blackstone Casino and Resort. They operate behind the scenes as the landlord, the owner of the physical shell. To the average tourist, the casino is still MGM Caesars. The branding, the logos, and the customer-facing experience all remain the same. You would have no idea that the ultimate owner of the property you're standing on is a private equity firm hundreds of miles away. It's an invisible empire hiding in plain sight. This lack of transparency is a hallmark of the private equity industry. As their name suggests, they are private. They are not publicly traded companies, so they don't have the same disclosure requirements. They don't host quarterly earnings calls for the public, or issue detailed reports on their operations. They answer to their investors, who are a select group of the world's wealthiest institutions and individuals. This creates a massive information asymmetry. They know everything about the companies they own, but the public, the workers, and even the regulators often know very little about them. This opacity gives them a tremendous advantage. This strategy is also surprising because it subverts our entire idea of what a casino mogul is. We think of people like Steve Wynn Sheldon Adelson, flamboyant, public-facing figures who built their empires brick by brick and put their personal stamp on their properties. Blackstone represents the complete opposite of this. It is the rise of the faceless institutional owner. The new king of Vegas isn't a person, it's a balance sheet. The story isn't glamorous, it's financial engineering beneath neon lights.